What's up, everybody? This is Sunko, the Korean bro. Today is 2023, May 29th. Okay? Okay, let's see. Two ways Alibaba stock could create enormous value for investors. 4 reasons to buy Netflix stock and 1 reason to sell. The trade that stock headed to $80. A bull market is coming. 3 reasons to buy Coca-Cola stock. Shopify buy, sell, or hold. Here's the one average Social Security retired worker benefit by age. One stock down 88% to buy and hold for 10 years. Hmm. Hmm. Okay. 2 ways Alibaba stock could create enormous value for investors. Alibaba has been eking out ways to unlock the potential of its varied businesses. The Chinese tech giant will spin off its cloud business and these two other subsidiaries. Its robust stock buyback program should also enhance shareholder returns. Alibaba could finally be on a sustainable trajectory as it rolls out a host of strategic moves. Alibaba could finally be on a sustainable trajectory as it rolls out a host of strategic moves. Stock has had a tough time in the last 2 years as the company faced declining growth and increasing competition. Still, the tech conglomerate has not given up. Alibaba recently announced a variety of steps to enhance shareholder value. Two strategy moves in particular could create significant value for investors. Let's take a look at them. The creation of Little Babas. Alibaba has exemplified Chinese massive success in the last 2 decades. Founded as an e-commerce business, the tech conglomerate has over the years built a business empire spanning cloud computing, uh, logistics, fintech, entertainment, and others. But with its success came at its worst enemy: size. Its massive proportions makes it extremely difficult for management to focus on all the different components of the company, primarily since many of these younger businesses operate at different growth stages with varying nuances. While the share buybacks to enhance shareholder return, the stock could be rewarding in the long run. It wasn't easy to be an investor in Alibaba over the last 2 years as the stock declined more than 70% from its all-time high price of $317. While it's still early, Alibaba recent move to streamline its business and buy back its stock in a big way could be rewarding to investors willing to look beyond the near term. And with the stock trading a low price sales ratio of 1.7 versus an average of 6.1 in the last 5 years, holding stock over the long term could be financially rewarding. Okay, Alibaba. Netflix stock more than doubled over the past year. The bearish concerns about its near-term growth are dissipating. It's still trading like a FANG stock instead of a media company. Is the volatile streaming media stock finally worth buying? Has taken investors on a wild ride over the past 2 years. The streaming media giant shares surged during the buying frenzy in growth stocks and closed at an all-time high of $691.69 on November 17, 2021. Hmm, okay. However, Netflix stock plummeted to a multi low of $164.28 on June 14, 2022, as its growth decelerated. It lost subscribers for the first time in over a decade, and rising interest rate deflated its valuations. But after sinking to that nadir, Netflix stock more than doubled to about $380 over the past year. Is it finally safe to buy Netflix stock after those massive price swings? Let's review four reasons to buy Netflix and one reason to sell it to see whether it's still a good investment. When Netflix launched paid subscribers in the second quarter of 2022, it finally admitted that it was facing stiff competition from other streaming media platforms. That warning convinced the bears that Netflix's high growth days were over. Its growth was still stalled out as fierce competitors like Disney, Amazon, Warner Bros. Discovery, and Paramount carved up the market. But if we look at Netflix's growth over the past year, we'll see actually gained subscribers again and its revenue growth stabilized. The expansion of its advertising business. Netflix has traditionally generated most of its revenues by charging subscription fees for ad-free programming. Has traditionally generated most of its revenues by charging subscription fees for ad-free programming. But that changed last November when it launched its cheaper ad-supported tier across a dozen markets. This ad-supported tier could help Netflix attract more budget-conscious consumers while widening its moat against similar ad-supported tiers at Disney Plus, WBD's HBO Max, and Paramount Plus. It could also attract more advertisers and diversify its top line away from its ad-free subscription fees. Netflix hasn't disclosed any revenues figures from its new ad-supported tier yet, but it recently revealed it had nearly 5 million monthly active users. That would only account for about 2% of its paid subscribers, but that ratio could climb as Netflix launches the tier in additional markets. 4 years, Netflix looked the other way toward password sharers, but this year it finally cracked down on the practice by charging extra fees for shared passwords. Um, the expansion of its advertising business, expansion of its advertising business, and its crackdown on shared passwords, and Netflix stabilizing growth rates. Netflix lost paid subscribers second quarter. It finally admitted that it was facing stiff competition. Hmm. Stabilizing operating margins. Netflix's investment in new content and currency headwinds have squeezed its operating margins over the past year. However, it also expects its operating margin to expand from 18% in 2022 to 18 to 20% in 2023 as its revenue growth stabilizes, the dollar weakens, it cut costs, and expands its higher margin advertising business. Those healthy operating margins suggest Netflix will remain the only profitable streaming video platform, while Disney, WBD, and Paramount continue to rack up steep losses under competing platforms. Okay. The trade desk headed to $80. Analysts rushed to lift their price targets for a trade desk stock after the company's recent earnings report. The ad tech company's first quarter revenue and earnings both easily beat an analyst estimate. Management guided for strong growth in quarter second too. Even after the stock's more than 50% gain this year, when analysts thinks the ad tech company shares have more room to run, with the Nasdaq Composite surging 24% year to date, some investors may be worried they've missed out on many of the buying opportunities that presented themselves when the Nasdaq fell 33% in 2022. But there are still opportunities in the market for investors who look close enough. One tech stock that has impressed this year in terms of both stock performance and live business performance is Trade Desk. Coming off of an exceptional um, first quarter report in which management provided upbeat guidance, the ad tech company is one growth stock that seems to be living up to its valuation, even after its shares have surged this year. Following the trade desk's latest quarterly update, analysts have been racing to upgrade their 12-month price targets for stock. Most of the revised price targets sit at $75 or higher, though the recently updated targets range between $60 and $80. Quite a tight range for stocks as volatile as a trade desk. The path to $80. Oppenheimer analyst Jason raised his 12-month price target for trade desk shares from $75 to $80 following the company's first quarter earnings report in early May, citing trade desk best-in-class demand SaaS platform, its positioning in fast-growing parts of the advertising market. Given the company's recent performance, it's difficult to make a case against the trade desk underlying business. Despite a tough macroeconomic environment, suppressing growth for almost every major tech company's digital advertising business, the trade desk managed to grow first quarter revenue at a staggering rate of 21% year over year, confirming Halfstein's bullish view of the trade desk cutting edge, market leading platform. The company is taking significant market share, given its growth rate related to the approximately flat growth most of other digital advertisers are reporting this year. As customers seek to optimize their ad spend, the trade desk is well positioned to deliver value and drive, as we demonstrated in late 2020. The trade desk management explained the company's first quarter earnings call. So is the trade edge stock buy today. For investors willing to endure the stock's volatility and hold for the long out, the company's strong business performance recently makes a great case for paying off for shares. But investors may want to keep up any purchases small as portion of their total portfolio. The stock does seem borderline fully valued with a price to free cash flow ratio of about 66. Hmm. Shopify buy, sell, or hold. Its business has been challenged as the economy emerges from the pandemic. While revenue continues to grow, operating losses have also increased. The stock's valuation is cheaper than its historical average, but it's still not cheap. Okay. Well, the leading e-commerce platform provider is still posting strong growth, but its bottom line remains in the red. Like other e-commerce business, Shopify benefited from a huge surge in online shopping that occurred during the worst of the coronavirus pandemic. Sales were skyrocketing, and the company was posting positive operating profits for several quarters. Uh, However, with the uncertain economic environment, inflation on everyone's minds now, Shopify's growth has moderated, and shares have retreated sharply from their 2021 peak. Its stock has still produced a remarkable 300% return over the past 5 years. This means $1,000 investment in Shopify back then will be worth more than $4,000 today. Past returns are wonderful, but what should investors do about this stock now? Let's take a closer look at this top e-commerce business. Sizing up the latest numbers. Shopify, which provides services that make it incredibly easy and seamless for business to start selling online, has seen its growth slow. This is especially the case when compared to a couple of years ago, but the numbers are still impressive. In the latest quarter, gross merchandise volume increased 15% year over year to $49.6 billion. Hmm. We achieved this GMV strength primarily through more resilient consumer spend. We strength in Europe being particularly notable, existing merchant same-store sales growth, and growth in our merchant base. CFO Jeff Homister stated on the first quarter earnings call, those are clearly all positive trends. Revenue was up 25% during the period, driven by a record attach rate of 3.04%. The attach rate, often called a take rate, is calculated as revenue divided by GMV, essentially measuring how much of the dollar volume on its platform Shopify gets to keep. The company noted that merchants are buying more services and solutions. The leadership team is trying to temper its expectations. Our perspective on the rest of the year remains cautious and assumes that inflation remains elevated, which may pressure consumer spending. Management said in its earnings presentation, nonetheless, executives are optimistic enough to forecast a similar rate of revenue growth in the current quarter to what was achieved in quarter first. Some other things to keep in mind. It's certainly encouraging to see Shopify put up solid double digit GMV and revenue growth, particularly at a time when inflation is leading to lower discretionary spending power for consumers. The company's strong momentum could be enough to keep shareholders happy. But investors should also pay attention to another important financial figure. In the most recent quarter, Shopify's operating loss was $193 million, which was roughly double the operating loss of $98 million in quarter first 2022. This happened despite revenue rising. That's obviously not a good result for a company that should be inching closer to profitability on a GAAP basis as it achieves greater scale. Hmm. One stock down 88% to buy and hold for 10 years. Fever's business has slowed since the early days of the pandemic. The company is working on cutting expenses to become more efficient. Uh, Fever will profit from the rise of the gig economy over the next decade. Okay, Fever International Storage, now familiar on Wall Street. The gig economy specialist saw its business and stock price experience a significant boom early in the COVID-19 pandemic, but the factors that led to increased activity on its platform have slowed, leading to lower revenue growth and a stock price in free fall for the better part of 2 years. Fiverr shares are down by 88% since July 2021. Still, there is much to like about the company's business, especially for those investors focused on the long game. So let's consider why Fiverr could be an outstanding buy and forget stock. Hmm. An increased focus on efficiency. Even when its revenue was growing rapidly in 2020 and 2021, Fiverr was not consistently profitable. But at least investors could ignore the red ink on the bottom line then, since its top line was so impressive. Now that its revenue is not increasing nearly as fast, the market is punishing Fiverr accordingly. The good news is that management has focused on cutting costs and driving greater efficiency. These initiatives seem to have paid off when looking at Faber's first quarter results. The company's revenue increased by 1.5% to almost $80 million. However, the company's cost of revenue and operating expenses declined, leading to a net loss per share of 0.11 $11 compared to the net loss per share of 0.46 reported in the prior year quarter. The company plans to remain focused on efficiency so that investors can expect more of the same in the coming quarters. Another vital aspect of Favor's business is worth mentioning, namely the company's margins. Margins in the neighborhood of 80%, which Favor has been able to pull off over the past 3 years, are extremely attractive. As the company cuts operating expenses, it should be able to reach sustained profitability, but only if its revenue growth can rebound. Let's look into why we can expect that to happen eventually. The gig economy is just getting started. The Fiverr has built a popular platform connecting freelancers to businesses looking to hire someone to perform professional services quickly. The company had 4.3 million active buyers as of the end of the first quarter, an increase of 0.3% year over year. But the gig economy isn't just some pandemic trend that will fade eventually. Instead, freelance work has grown in popularity in recent years. For instance, while overall job growth in the US economy was 1.1% between 2010 and 2020, freelance job growth was at 15%. Hmm. By then, there were 59 million people who took part in the gig economy in the country. It's not surprising that more workers are switching to this option. It grants people flexibility and greater control over their schedules. The 9 to 5 model does not fit a lot of people's lifestyles, but it's also benefit since hiring freelancers who aren't entitled to benefits and paid time off is faster and cheaper than getting employees on board. As one of the leading companies in the niche and having already developed a reputation, Fiverr should continue to attract more businesses and freelancers. Fiverr's website serves a capital critical purpose. It saves freelancers the trouble of doing a lot of marketing themselves. Creating a website full of samples of your work from scratch to attract potential customers is harder. Creating a website full of samples of your work from scratch to attract potential customers is harder than posting the same samples on the website where people will come looking for the services you provide. Meanwhile, Fiverr's platform increases in values as more people join, since more businesses attract more workers and vice versa. This competitive advantage is another reason to expect Fiverr's user base and revenue to continue on the right path. Worth the wait. Will Fiverr beat the market in the next year, given the challenges it faces and the difficult economic conditions? Probably not, but over the next decade, that's a different story. The gig economy is expanding rapidly, which will eventually trickle down to Fiverr's top line growth. While some are worried that the rise of AI chatbots like ChatGPT will be a problem for Fiverr since it could replace a lot of the jobs or retire through its platform, the company reported the AI-related gigs have increased tenfold in the past 6 months alone. Management believes AI will be a net benefit for Fiverr, not a net negative. Meanwhile, with the company's cost-cutting measures and high gross margins, profitability should come well before the end of the next decade. Thanks to these dynamics, Fiverr is well positioned to reward patient investors through the next 10 years and perhaps well beyond that. Wood really believes in Tesla, so much so that the fund manager expect Tesla shares to hit $2,000 by 2027. Uh, that will represent an increase of 927% from its current level and value the company at $6.3 trillion. So, what is it that has Kathy Wood so excited about Tesla? In a nutshell, it's a combination of three factors: increasing production figures, full self-driving, robotaxis. Each of these characteristics builds upon one another. It starts with expanding production numbers. With each Tesla that rolls off the assembly line, the company acquires a new platform for technology that Wood sees as the next cheaper chapter in Tesla's story. And this goes on and on and on. And one another stock that Kathy would recommend is Coinbase. Coinbase is not my type because it's related to cryptocurrency. Mm. We'll go over to Roku instead. Okay. Mm. Let's keep on reading the rest of articles about Tesla, and then we'll go over to Roku. It starts with expanding production numbers with each Tesla that rolls off the assembly line. The company acquires a new platform for the technology that Wu sees as the next chapter in Tesla's story. Once the Tesla is on the road, consumers can enable full service driving, and while the system remains far from perfect, and Tesla and Wood are quick to note that full service driving is already safer than human only controlled vehicles. Finally, once Tesla can break through the final barrier of removing a human driver from the vehicle altogether, an enormous opportunity presents itself: autonomous robotaxis. A fleet of self-driving robotaxis could revolutionize transportation and blow Tesla's stock price sky high. And while there are plenty of naysayers when it comes to full-service driving robotaxis, Wood isn't worried. And after all, she have proved the critics wrong before. Remember, she bought her first shares of Tesla at a split adjusted price of $13 per share. So while owning Tesla shares isn't for everyone, I think Wood might be onto something. Hi, honey. Working? Not busy? Not busy. Yes, that's awesome. Awesome. Ah, I miss you too. I miss you too. I've been doing YouTube. Ah. It's first time that you tell me love me in this YouTube live. It's huge thing, Everyone would know, because I mean it's open, right? Oh, wow. Hmm. I wonder why. Why you say you love me? Is it because I send you money? Then I have to send you a lot of money. Okay. No? Oh. Awesome, awesome. Perfect answer. That's the answer that I wanted to listen to. Hmm. Oh, awesome. If I'm poor man, you will still love me. But guess what? I'm already poor. I'm poor man. You don't have to like put on assumption. I'm poor guy, so you don't you don't have to say like, oh, if you are a poor guy, I will still love you. You don't have to. Anyway, okay, let me tell you what I was talking about. You love poor guy. Okay. Hmm. Well, let me say something. I got so much potential, and I got so much power deep within. I got huge dream. So what I'm trying to say is, um, I may be poor at this point, financially, but my love toward ah oh my god, I've been talking so many good stuff. Okay, let me tell you something. Okay, you have to listen to me carefully. Okay. Okay. What I tried to say was that I may be financially poor at this moment, but my love toward you is so huge and rich. You get what I'm saying? I may be financially uh, poor, but my love is so huge and rich. It's so rich. It's so rich that it will reach out to universe. It's that big. Hmm. And I got so much potential. I got so much. Yes, exactly. Love is so huge. Yeah, it's so fruitful. Yeah. Anyway, that's the point. Okay, I've been talking too much myself tonight. Instead of talking about stock. Anyway, okay, I was talking about Tesla and Roku, the company that mainly deals with what is it, like TV device. Hmm. Anyway, I might have to put an end to it tonight. It's been already 35 minutes since I started doing YouTube live, and it's already 12:17. I gotta go to bed, and tomorrow is work day. So, Uni, I'll talk to you. I'll send you a Kakao message, okay? I'm not sure if you're listening to me or not. Okay. Uni, bye bye. Okay.